Today we will learn how loans work before you borrow. Many people utilize debt to pay for things that they wouldn't be able to buy otherwise, such as a home or a car. While loans can be beneficial financial instruments when utilized correctly, they can also be formidable foes. Before you start borrowing money from eager lenders, you need to understand how loans work and how money is made for the lenders to avoid getting into too much debt. In the financial world, loans are big business. They're utilized to help the lenders make money. No one likes to lend money to someone who hasn't promised to repay it. Keep that in mind as you look for loans for yourself or your business. The way loans are organized can be confusing and can lead to massive debt. Before you borrow money, you should understand how loans work. You can save money and make better debt decisions if you have a better understanding of them, such as when to avoid taking on more debt, and when to use it to your benefit. Elements of a successful loan. Before you borrow, it's a good idea to familiarize yourself with several basic terminology that apply to all forms of loans. The phrases principal, interest rate, and period are used here. Principal. The principal is the amount of money you agreed to repay a lender when you took out a loan. Term. This is the length of the time that the loan will be in effect. You must pay back the money within this deadline. The terms of various sorts of loan vary. Credit cards are revolving loans, which means you can borrow and return as much as you want without having to pay for a new loan. Rates of interest. This is the fee your lender will charge you to borrow money. It's usually a percentage of the loan amount, and it's determined by the rate at which the Federal Reserve charges banks to borrow money overnight. The federal funds rate is the rate on which banks base their own interest rates. The federal funds rate is the basis for a number of rates, including the prime rate, which is a lower rate reserved for the most creditworthy borrowers, such as companies. Smaller enterprises and people with variable credit scores are offered medium and high rates, indicating that they pose a greater risk to the lender. Expenses related to loans. Understanding the charges of a loan might assist you in deciding which one to take out. Costs aren't always disclosed up front when applying for a loan, and they're frequently expressed in financial and legal jargon that's difficult to understand. Costs of interest. When you borrow money, you must repay the amount borrowed plus interest, which is normally spread out over the loan's length. You can acquire a loan for the same principal amount from multiple lenders, but you'll pay a different amount of total interest if the interest rate and/or period differ. When rates are taken into consideration, the expenses to a borrower might be misleading because it does not account for compounding interest that is paid over time. Creditors most commonly promote the annual percentage rate APR of a loan. For example, if you were offered a 6% APR on a $13,000 4-year auto loan with no money down and no extra fees, compounded monthly, you would pay $1,654.66 in interest. A 4-year loan may have larger monthly payments, but a 5-year auto loan will cost you $2,079.59 in interest. Multiplying the principal by the interest rate and the number of loan periods per year is the straightforward way to determine your loan interest. However, not all loans are structured this way, and you may need to use a loan amortization calculator or an annual percentage rate calculator to figure out how much you'll pay over the life of a loan. The term amortization refers to how money is applied to the main and interest balance of your loan. Every period you pay a set amount, but depending on the loan terms, the amount is split differently between principal and interest for each payment. Your interest expenses per payment decrease with each payment. An illustration of how a monthly payment is applied to principal and interest is shown in the amortization table. Fees. You may be required to pay fees on loans from time to time. Depending on the lender, you may be required to pay a variety of fees. The following are some examples of frequent fees. Application fee covers the cost of the loan approval process. Processing charge. This fee, like the application fee, covers the cost of administrating a loan. The cost of obtaining a loan is known as the origination fee, most common for mortgages. Annual charge. This is a one-time fee that you must pay the lender every year, most common for credit cards. Late fee. The amount charged by the lender if you miss a payment. Prepayment penalty. The penalty for paying off a debt early, most common for home and car loans. Lenders rely on interest income from loans to make a profit. When you pay off your loan early, they lose the amount of interest that they would have received if you hadn't paid it off. The prepayment charge is intended to compensate them for not obtaining all of the interest money they would have received if you hadn't paid it off. These fees are not included in all loans, but you should be aware of them and ask about them when considering a loan. Becoming eligible for a loan. You must meet certain criteria in order to obtain a loan. Lenders only make money if they are confident that they will be repaid. Lenders consider a number of variables when determining whether or not you are qualified for a loan. Your credit score is important in determining your eligibility because it reflects how you've used loans in the past. You're more likely to acquire a loan with a fair interest rate if you have a higher credit score. You'll almost certainly need to demonstrate that you have sufficient revenue to repay the loan. Lenders frequently consider your debt-to-income ratio, which compares the amount you owe to the amount you make. If you don't have a good credit score or are borrowing a large sum of money, you may be required to put up collateral to secure the loan, commonly known as a secured loan. If you can't pay back the debt, the lender can seize and sell something you own. You may even need to have a cosigner on the loan with strong credit, which means they agree to pay it if you can't. Making an application for a loan. When you need money, you go to a lender and apply for a loan, either online or in person. A smart place to start is your bank or credit union. Working with specialized lenders, such as mortgage brokers and peer-to-peer finance platforms, is also an option. The lender will assess your application after you have provided personal information and will decide whether or not to grant you the loan. If you're authorized, the lender will send funds to you or the entity you're paying. For example, if you're purchasing a house or car, the payments may be paid directly to the seller. You'll begin repaying the loan on an agreed-upon recurring date, typically once a month, with a predetermined rate of interest shortly after getting the funds. Most commonly asked questions, FAQs. What is the best way to repay a loan? The details of how to repay your loan will be included in your loan agreement, and the exact structure will depend on the sort of loan and conditions you have. In most cases, you'll make a payment on a monthly basis by the due date. You may usually set it up as an automated draft or send a monthly check to your lender. If your loan allows it, you can make extra principal payments to pay it off faster. How can I figure out how much I owe on a loan each month? Your monthly payment amount and due date will be listed on your loan agreement. If your lender emails monthly statements, on any monthly statements you receive. You may definitely set up an online account with your lender and check your payment details there as well. Is it possible to adjust my loan payment? You can always increase your payment amount to pay off your loan sooner if your loan doesn't contain any early payoff penalty. If you wish to make a smaller monthly payment, you'll need to refinance your loan to a lower amount or a longer term. If you enjoyed our video, please click the like and subscribe button below for more financial tips.